The email arrived at exactly 6:42 a.m. Subject: Proposal declined. I read it twice. Not because I didn't understand the words. Because I couldn't understand the decision. For 3 years, my team had built an artificial intelligence platform capable of detecting financial fraud before transactions were completed. Not afterward. Not hours later. In milliseconds. Banks spend billions every year investigating fraud after the money disappears. I believed they were solving the wrong problem. If suspicious transactions could be identified before approval, most losses would never happen. The technology wasn't magic. It analyzed thousands of signals simultaneously. Transaction history, device fingerprints, behavioral patterns, geographic inconsistencies, merchant relationships, network activity. Every payment created a unique digital fingerprint. Our platform compared that fingerprint against billions of previous transactions in real time. When risk exceeded a defined threshold, it requested additional verification before money left the account. Simple, fast, effective. We called the platform Sentinel Pay. During 12 months of pilot testing with several regional financial institutions, fraud losses fell by nearly 40%. False alerts also decreased. Customers experienced fewer unnecessary account freezes. Everyone who used the system wanted to expand it. Everyone except the largest banks. According to them, the platform was too expensive, too complex, too disruptive. One executive summarized their decision in a single sentence. We've managed fraud for decades. We don't need artificial intelligence telling us how to run a bank. The meeting ended. 3 weeks later, our contract negotiations officially collapsed. Investors became nervous. Without a major banking customer, raising additional funding became almost impossible. Several board members suggested selling the company. One acquisition offer valued Sentinel Pay at just $80 million. 5 years of work. Hundreds of thousands of engineering hours. Worth less than a mid-sized office building. I declined. My board thought I was making the biggest mistake of my career. Maybe they were right. For a while. Instead of chasing America's largest banks, we changed direction. Credit unions. Regional lenders. Online payment companies. Digital wallets. Fintech startups. They moved faster. They experimented more. Most importantly, they cared about preventing fraud before it happened. Within 4 years, Sentinel Pay processed hundreds of millions of transactions every day. Not because we won the biggest customers. Because we won thousands of smaller ones. Each new institution improved our AI. Each attempted fraud made the model smarter. Each prevented attack strengthened our reputation. Wall Street barely noticed. Until one Monday morning, breaking news interrupted financial television across the country. One of America's largest banks had disclosed a massive fraud incident. Unauthorized transactions spread across multiple payment networks. Business accounts. Consumer accounts. Corporate treasury systems. Losses mounted by the hour. Markets reacted immediately. The bank's shares plunged. Analysts demanded answers. Customers rushed to verify account balances. Regulators announced an emergency review. By the end of the week, the estimated financial impact exceeded $2 billion. That same afternoon, my assistant walked into my office carrying a sealed envelope. No return address. Inside was a single sheet of paper. Typed. No signature. Only one sentence. They rejected your system. Now they need your company. I looked out through the glass walls of our headquarters as trading screens across the financial district flashed red. 5 years earlier, the biggest banks believed they were too large to change. Now one of them had just learned an expensive lesson. The real question wasn't whether they would call. It was whether they were already too late. The phone rang before the markets opened. Unknown number. New York. I answered. This is Daniel Mercer. The voice sounded familiar. 3 seconds later, I remembered why. 5 years earlier, Daniel had chaired the meeting where Sentinel Pay was rejected. He had been the bank's chief risk officer. Back then, he politely explained why artificial intelligence wasn't necessary. Today, his voice carried none of that confidence. We need to meet. I didn't answer immediately. Instead, I looked at the morning headlines. Bank fraud losses continue to grow. Regulators expand investigation. Payment networks under pressure. The story had become national news. When? As soon as possible. 3 hours later, I walked into the headquarters of America's third largest commercial bank. Security was tighter than I remembered. Media trucks lined the streets. Employees avoided eye contact. Conference rooms were full. Nobody smiled. The crisis wasn't over. It was getting worse. Daniel greeted me outside the executive floor. I appreciate you coming. I was curious. He opened the boardroom doors. Inside sat 12 directors, general counsel, technology executives, outside advisors, even representatives from the bank's insurance carrier. The atmosphere felt more like an emergency command center than a corporate meeting. Without introductions, Daniel projected a dashboard onto the wall. Unauthorized payment activity. Every minute, the numbers increased. Corporate wire transfers, business payment accounts, commercial treasury clients, international settlements. The attacks weren't random. Someone understood exactly how the bank detected fraud. Every defensive rule they created, the attackers adapted within hours. One director finally asked the question: can Sentinel Pay stop this? I studied the data carefully, then shook my head. No. The room became silent. Daniel frowned. No. Not like this. I walked toward the display. The attackers aren't defeating your fraud system. They're studying it. I highlighted several transaction clusters. They know which alerts your software prioritizes. They're staying just below every threshold. One executive interrupted. How is that possible? Because your platform relies on fixed rules. Our AI doesn't. That difference changed everything. Traditional fraud systems searched for known patterns. Sentinel Pay searched for changing behavior. It didn't ask, has this happened before? It asked, does this make sense right now? That single distinction had taken years to build. Another executive leaned forward. If we license Sentinel Pay today, how long? 30 days. The room filled with disappointed expressions. We don't have 30 days. I know. Daniel closed the presentation. Then what do we do? Before I could answer, my chief engineer, Maya, sent an urgent message. Call immediately. I stepped into the hallway. What happened? Our network. What about it? We're seeing the same transaction patterns. I stopped walking. On our customers. No. She hesitated. Across the entire payment ecosystem. That shouldn't have been possible. Sentinel Pay protected hundreds of financial institutions. But not enough to observe nearly every major payment channel. Unless the attackers weren't targeting one bank. They were testing the entire financial system. Back inside the boardroom, I requested access to the bank's historical transaction data. Billions of payment records appeared on secure servers. Pulse after pulse of financial activity. Millions of legitimate transactions. Thousands of fraudulent attempts. Then Maya connected Sentinel Pay through an isolated analysis environment. The AI processed the data for nearly 20 minutes. Nobody spoke. Finally, a new visualization appeared. Instead of highlighting fraudulent transactions, the system highlighted relationships. The attackers weren't stealing money randomly. They were mapping trust. Every successful payment taught them something. Which accounts received fewer security checks? Which merchants triggered automatic approval? Which transaction sizes avoided manual review? They weren't launching one attack. They were conducting millions of tiny experiments. Learning. Adapting. Improving. Exactly the way artificial intelligence learns. The board members stared at the screen. One quietly whispered, "We're training them." Nobody answered. Because he was right. Every failed fraud attempt made the attackers smarter. Every defensive adjustment created new information for them to study. Then Maya noticed something even stranger. Look at the timestamps. The attacks almost completely stopped between 2 a.m. and 4 a.m. Eastern Time. Every night. Exactly the same window. Why? Human attackers don't usually keep perfect schedules. Machines often do. Our AI ran another analysis. Seconds later, a world map appeared. The transaction activity aligned almost perfectly with the operating hours of several major financial data centers. Someone wasn't simply attacking banks. Someone was measuring the performance of the infrastructure connecting them. The room fell silent. Daniel slowly looked at me. This isn't about $2 billion anymore. I nodded. No. It's about understanding how money moves. Before anyone could continue, every phone in the room vibrated simultaneously. A breaking news alert flashed across the screens. Another major U.S. bank had reported unusual payment activity. Then a third. Within minutes, financial markets began falling again. Investors suddenly realized this wasn't an isolated incident. Confidence, the invisible foundation of banking, was beginning to crack. My phone rang one more time. Unknown number. I answered. A calm voice spoke only 9 words. You're protecting banks. We're studying the future of money. The line went dead. For the first time since founding Sentinel Pay, I realized we weren't competing against ordinary cybercriminals. We were competing against someone trying to redesign the financial system itself. The room remained silent long after the call ended. Nobody asked who it was. Nobody needed to. The message itself mattered more than the voice. We're studying the future of money. Asterisk. Daniel turned toward the legal team. Notify the regulators. They're already on their way. Within an hour, representatives from federal banking agencies arrived. Not because billions had already been lost. Because confidence was becoming the real risk. Banks can survive fraud. They struggle to survive when customers stop trusting the system. One regulator asked me a simple question. If this isn't ordinary financial crime, what is it? I didn't answer immediately. Instead, I requested data from every Sentinel Pay customer willing to participate. Regional banks, credit unions, digital payment providers, online lenders. More than 400 institutions agreed. For the first time, our AI could observe an enormous portion of the payment ecosystem. Millions of transactions streamed across our secure analysis platform every second. The volume was unlike anything we had ever processed. Then Maya noticed something no human analyst could have found. Pause. She froze the visualization. Every attack looked different. Different accounts. Different merchants. Different payment amounts. But one characteristic never changed. Timing. Not the time of day. The interval between transactions. Exactly 1.8 seconds. Again. And again. And again. Too precise for humans. Too consistent to be random. It isn't one criminal group, Maya said quietly. It's one decision engine. Our AI compared the pattern against known fraud networks. No match. Then it compared the timing to high-frequency trading systems. The similarity exceeded 94%. The attackers weren't thinking like thieves. They were thinking like quantitative analysts. Testing. Measuring. Optimizing. Every transaction was an experiment. Every response from a bank became another data point. Daniel leaned forward. They're building a model. Yes. A model of what? I zoomed out from individual transactions. Instead of showing accounts, the AI displayed connections between financial institutions. Lines spread across the country like a living network. Banks. Payment processors. Card networks. Business accounts. Settlement providers. Money wasn't moving randomly. It flowed through predictable pathways. The attackers weren't trying to steal every dollar. They were trying to understand every pathway. Who approved payments? Who verified identity? Who delayed settlements? Who trusted whom? Once they understood the map, future attacks would become dramatically more effective. A federal investigator looked at the screen. They're learning the architecture of trust. Exactly. Money wasn't the objective. Knowledge was. Late that afternoon, another alert interrupted the meeting. One of our smallest customers, a credit union with fewer than 50,000 members, had blocked a sophisticated fraud attempt. Loss prevented. Only $12,000. Hardly headline news. Yet our AI immediately flagged it as the most important event of the day. Why? Because the attackers reacted differently. Instead of trying again, they stopped. Completely. For nearly 40 minutes. Maya enlarged the timeline. They're evaluating failure. That made no sense. Unless the decision engine had discovered something unexpected. We isolated the blocked transaction. Nothing unusual. Until we examined the authentication sequence. The credit union had recently adopted an experimental identity verification method developed by a small startup in Colorado. Almost nobody knew it existed. The startup had fewer than 30 employees. No major bank used its technology. Yet somehow, that tiny company had interrupted the attacker's learning process. I requested a background report. Founded 3 years earlier. Privately funded. Minimal publicity. Then one detail caught my attention. Its largest investor. Northbridge Capital. Nobody in the room recognized the name. Our AI searched public records. Northbridge had quietly invested in dozens of obscure financial technology companies. Identity verification. Secure messaging. Digital signatures. Encryption hardware. None were large. None attracted headlines. Together, they formed a remarkably complete financial security ecosystem. Daniel looked at me. They're not investing in banks. No. They're investing in everything banks eventually depend on. The pattern felt strangely familiar. Not ownership of the financial system. Ownership of its foundations. That evening, I received another invitation. No corporate logo. No signature. Just an address. A private research facility outside Washington, D.C. Against everyone's advice, I accepted. The building looked ordinary. Inside, nothing about it was ordinary. Large digital walls displayed real-time payment activity from around the world. Not individual customers. Anonymous economic flows. Trade settlements. Business payments. international commerce, energy transactions, healthcare reimbursements, supply chain financing. A man in a gray suit introduced himself. My name is Adrian. He extended his hand. I've been hoping we'd finally meet. You work for Northbridge. He smiled slightly. I work with people who study financial infrastructure. I folded my arms. You've invested in half the companies building it. We invest in resilience. He walked toward the digital wall. Tell me, Ethan. What do you think a bank sells? Financial services. Adrian shook his head. No. They sell confidence. He pointed toward billions of moving transactions. Every payment succeeds because two strangers trust an invisible system. If that confidence disappears, he paused. The economy slows long before people realize why. I remained silent. Because he was right. He turned back toward me. You built Sentinel Pay to stop fraud. That's admirable. But fraud is only a symptom. Then what's the real problem? Adrian looked directly into my eyes. The next generation of finance won't be won by the bank with the most branches. He paused one final time. It will be won by the company people trust to verify every transaction. As I left the facility, the city lights reflected across the windshield. For years, I believed Sentinel Pay was protecting banks. Now I understood something much larger. We weren't competing to stop criminals. We were competing to become part of the invisible trust that powers every dollar moving through the global economy. And that race had only just begun. The next 6 months changed the banking industry forever. Not because of another massive fraud attack, but because thousands of financial institutions reached the same conclusion at the same time. Waiting until money disappeared was no longer an acceptable strategy. Risk had to be understood before it became loss. Sentinel Pay expanded faster than anyone predicted. Regional banks signed first. Then commercial lenders, credit card issuers, digital payment platforms, insurance companies, brokerage firms. Eventually, even the largest banks that had once rejected us returned. This time, they weren't negotiating from a position of strength. They were asking for help. Daniel visited our headquarters one final time. No lawyers. No investment bankers. No board members. Just the two of us. He stood in front of the operations center where thousands of secure transactions were being analyzed every second. I owe you an apology. You don't owe me anything. He smiled. I do. We thought experience was enough. We underestimated how quickly the financial world was changing. I nodded. The hardest part of innovation isn't building better technology. It's convincing successful companies they need it before a crisis forces them to agree. For the first time since we met years earlier, we weren't discussing contracts. We were discussing the future. Instead of acquiring Sentinel Pay, the bank proposed a long-term strategic partnership. Independent governance. Shared security standards. Joint research. No exclusive ownership. We accepted. Not because it was the largest financial offer. Because it aligned with the mission we had started years before. A month later, federal banking regulators announced new industry guidelines encouraging adaptive, AI-assisted fraud detection, stronger oversight, and greater transparency while emphasizing privacy and accountability. The goal wasn't to replace human judgment. It was to give skilled professionals better tools. Across the country, fraud losses began to decline. Customer confidence improved. Financial institutions shared threat intelligence more quickly than before. Competition remained fierce. Security improved for everyone. One evening, Maya walked into my office carrying our latest annual report. She laughed. You remember when investors said nobody would buy this? I smiled. I remember. She placed 2 charts on the table. The first showed revenue. The second showed prevented fraud. The second chart mattered far more to me. Billions of dollars protected. Millions of customers spared the stress of unauthorized transactions. Thousands of small businesses that never had to wonder whether payroll would arrive. Those numbers represented something more valuable than profit. Trust. Weeks later, I was invited to speak at a national financial technology conference. Instead of showing product demonstrations, I began with a simple question. What is the most valuable asset a bank owns? The audience answered with familiar words. Capital. Deposits. Technology. Brand. I shook my head. The answer is confidence. If people trust the system, they invest. They build companies. They hire employees. They buy homes. They plan for the future. But confidence isn't created by advertising. It's earned one secure transaction at a time. When the presentation ended, a young entrepreneur approached me. My startup was rejected by every major bank. He looked discouraged. What should I do? I remembered reading the email that changed my life years earlier. Proposal declined. I smiled. Don't build your company to impress the biggest customer. Build it to solve the biggest problem. The customers who understand its value will find you. He thanked me and walked away. Late that night, as I prepared to leave the office, I noticed a plain white envelope resting on my desk. No logo. No return address. Inside was a single handwritten note. The strongest financial systems aren't the ones that never face attacks. They're the ones that learn faster than the people trying to break them. There was no signature. I never discovered whether Adrian truly represented Northbridge Capital or simply believed in the same future we did. In the end, it no longer mattered. Because the lesson had become clear. Technology alone doesn't create trust. People do. Engineers who design secure systems. Analysts who question assumptions. Bank employees who protect customers. Entrepreneurs willing to challenge outdated ideas. Innovation isn't about replacing people. It's about helping them make better decisions. Years earlier, the largest bank in America believed our company was too small to matter. 5 years later, they discovered something every successful business eventually learns. The greatest competitive advantage isn't having the biggest balance sheet. It isn't the tallest headquarters. It isn't even the most advanced technology. It's earning trust before anyone else does. As the lights in the operations center dimmed, millions of secure transactions continued flowing across our network. Invisible, reliable, protected. Exactly the way the world's financial system should be. The end.